Afternoon, everyone, and hello. Welcome to today's webinar on finance and community shares. This hosted as part of the Community Energy Go project. I'm John Taylor, Head of Capacity Building and Strategic Development at Community Energy England, and I'll be chairing the session today. Please do feel free to introduce yourself in chat. We are recording the session today and we'll be emailing the recording and slides afterwards. So yeah, don't worry too much if you're having to make lots of notes. Yeah, you'll be able to access that once the session is done. So today we're joined by two really excellent speakers. We have Phillip Morris from Empowered and Simon Borkin, who is founder of Commonly. This webinar is part of a series of webinars delivered through a program called Community Energy Go. So if I just introduce a bit more about what Community Energy Go is. So many of you on the call will be aware of Community Go already, having received some support through it. But for those who aren't, it's a new project delivered in partnership by the Centre for Sustainable Energy, Community Energy England and Ashton. It's funded by the Energy Redress Scheme. The programme supports groups across England to turn their renewable energy idea into reality. And it provides you with expert advice, practical tools, and hands-on support to help you with your community energy projects, drawing along the existing expertise within the community energy sector. We have a Community Energy Go website where you can read more about the programme. The website also has a section on our eligibility criteria to look at. And if you haven't done so already, you can register your interest for support via that website. Yeah, we'll be sharing links around out there afterwards. I think it's all been officially launched now, so activity and interest is certainly ramping up. So a little bit of an overview for today's event. First, we'll be hearing from Phillip Morris from Empowered, who will give us an introduction to community energy financing. And we'll then hear from Simon Borkin from Commonly, whose presentation will focus on community shares and other crowdfunding mechanisms like community bonds as well might come up as well. But yeah, that kind of democratic community finance really is the heart of what makes community energy so special and democratizing ownership. We'll then have a Q&A for the two speakers, followed by a short break. When around 1 p.m., we'll come back together after that break and we'll open up some breakout groups. So you'll then have a chance to join a breakout group with either Philip or Simon. Whilst they do their presentations, have a think about which of those groups you would like to join, which will be most useful for you. And then those breakout group spaces will be a deeper dive with each speaker and a chance to ask more follow-up questions. We'll then wrap up and finish around 1:30 with next steps and a feedback survey. So I think we might as well get into the content of today's session. I'm now going to hand over to our first speaker, Phillip Morris, who is one of our expert associates working on Community Energy Go. He is the Senior Development Manager at Empowered. He's worked in the energy sector for over 18 years, working for the public, private, and third sector organisations. So very good range of experience of different commercial delivery models. He has a particular interest in local and community energy and has worked for Plymouth Energy Community and the Energy Learning Network. At Empowered, Phillip supports community energy groups to progress renewable energy projects from an initial idea through to construction. To try and help us keep to time, we'll be sending a rocket emoji around when speakers have 1 minute left, so look out for that. Over to you, please, Phillip.
Thanks, John. And hello, everyone. 18 years makes me feel really old, but I guess there are benefits to that too. So if you go on to the next slide, please, Faith. So I'm Phillip Morris. I work for a small consultancy called Empowered, and we work to support landowners around renewable energy. We also have a general renewable energy consultancy business, but a big part of what we do is supporting community energy organizations. And like John said, we're here to kind of try and help support right from the kind of first stage of thinking about a project all the way through to having that project up and operational. Next slide, please. In pitching this, what we were really keen to do is to kind of pick an appropriate level. So we're not doing a masterclass here. in community energy financing, nor do we have time to do that. The idea is a really kind of an introduction, and in particular, my presentation is really at the introductory level, knowing that we've got some time for a Q&A, but also that we've got the workshops later on. But it's a starting point, and it's about thinking about community energy in the way that that you structure community energy projects through finance, but also some of the kind of key principles of viability. So some of those things that kind of make or break a project. Next slide. But I've got loads of, yes, thank you. If you click through them all, Faith, and then that will probably be easier. I thought I was going to be operating this myself, which would have made it a bit smoother. But before I think you even get to finance, and this may feel kind of breathtakingly obvious, but it is really important to stop and think about your drivers and your objectives. So not in a really kind of pure project management sense, just in a kind of very pragmatic sense. What is it that you want to achieve? Because that's going to define in many ways your approach to how you kind of structure these projects and what projects will work for you. And it matters what you want to achieve with renewables. So this whole presentation, I'm kind of using solar PV at all scales as a kind of a proxy for renewable energy projects to kind of think about it through one lens. But generally, there's a question about what you want to achieve. Because if it's just to have more renewables locally, a community-owned model might not always be the appropriate thing, because actually you're layering in an extra layer of kind of costs and an expectation around community benefit. So it's a really obvious point, but it's worth thinking about what you want to achieve. And you might kind of have a mix of projects that does two different things. Some of your work might be about just getting more renewables out there and finding ways to fund and make that happen. And some of it might be about larger scale community owned renewables that generate a kind of margin that helps you build an organization off the back of it. It's also important to think about how much appetite you have for risk. So this is something I think about a lot. It's quite a risk averse problem, but there is a huge gulf of difference between the risk associated anxiety between a small rooftop scheme and a large shared ownership scheme where you're working with a commercial developer, a kind of multi-megawatt scale, and having a think as a group really early on about what that appetite for risk is really key. And that might change over time. You might start small and build confidence and build up, but being realistic about that and the time that it takes to get these projects over the line and how you're going to finance your time, resource your time over what could, in the case of a large solar farm, be years rather than months, is worth thinking about the offset. Next slide, please. Very basic, but just to make sure we're all on the same page, the kind of how community energy model works, I think in essence is and again, I'm using solar PV here, but you're leasing some land or a roof space. You're raising finance, and then in ways that we will discuss later on. But you're kind of pulling together some money to fund that yourself as a community energy organization in a kind of traditional community energy model, and then you're going to sell power. And what you hope is the income from selling that power is going to pay back where you've got the finance from, whether that be shareholders or a bank or both. It's going to cover your operational costs. And then what you hope is that you're going to have some margin at the end of that can be put into a community benefit fund. And your kind of expectations around that margin might be dependent on the scale of that project and how much you want to do that project. But that, I think, is the kind of traditional and simplest way of looking at the community energy model. Next slide, please. Again, feel free to go through all of these. So it is important from the outset, I think, about how to measure viability. And a lot of this can feel sometimes a bit overwhelming. I think sometimes it's kind of conflicting what people tell you. And often I think people are pretty confused themselves when they're talking through these terms. But really what you're looking at is, does this project earn more over its lifetime than it has cost me to build, including all my kind of wrapped up costs associated with that, and build and maintain? And one of the ways of considering that is net present value. And net present value is important here because solar projects and renewable projects generally have a really big capital cost upfront and then a very long revenue injection, could be 30 or 40 years. And the reason present value is important in that context is you're thinking about discounting the future value of money. So £1,000 to you in 30 years' time is worth less than £1,000 to you right now, both because of the opportunity cost of money, as in the other things that you might do with that money, but also the fact that because of inflation, the costs of everything around you will go up. And so the value of that money decreases. So net present value is a way of kind of accounting for that. And it's used quite differently according to whether you're in the public sector or the commercial sector, but really it's just a way of discounting that future value of money. That is helpful, but usually it gives you a kind of positive or negative metric. And actually, if you want to be able to compare projects, then the internal rate of return is a way of doing that. I'm using project IRR here because that's basically saying it is the internal rate of return before you consider all your kind of financing and debt costs. So IRR is useful because you can compare one project with another. And it's really a percentage of showing how much that project will earn over time. In technical terms, what it's doing is showing the percentage discount rate. We just talked about discount rate when that's at present value, at which net present value becomes zero. So if your return, your net present value is zero, then what is the rate of discount that you apply to that? And what is your project return? And I'm happy to kind of go into this and kind of talk about it more, but I guess IRR is most useful. It's a function in Excel. You can try and work it out yourself if you like, but it's most useful as a way of kind of comparing one project to another and being able to think about your rate of return is. When you do both those things, cash flow viability matters. So we'll talk about model stages in a minute, but ultimately you might start with thinking about what the project IRR is, your internal rate of return, but by the time you're getting ready to sign this off, you need to know about cash flow viability. And that is particularly relevant to community energy and the way we use withdrawable shares, which I think Simon will talk about later. But you need to know you've got enough cash in the bank to pay the bills. And then you need to think about your community benefit fund and what's reasonable. Next slide, please. So what does good look like? And good is going to be different for every different organization. And it's certainly different for community energy when you compare community energy to commercial organizations. But for the reasons I've said, a good NPV is a positive value. And there could be a lot of discussion about how positive that value is and what the scale, but effectively you're saying when you consider the discounting of money over time, and like I said, the fact these projects have a big capital injection up front and a very long revenue stream, is that project going to generate a return above its initial cost when you consider that discounting? So positive NPV is good. Then you can go further and say, what is your IRR? How positive that? And this is actually, I stole this from when I Google searched this and it came up in AI. And I'm someone who doesn't like to use AI, but I'm accidentally using it here. But it came up with a response as a good IRR is one that exceeds your cost of capital, beats inflation, and compensates for the risk of that investment. I actually think that's a pretty good summary. So are you getting enough rate of return to cover your cost of capital, as in the cost of the kind of getting and building that project, to account for the impact of inflation and compensates for the risk? Now, how a community expects to be compensated for risk is going to be very different to a commercial company, and it's going to be very different according to the level of risk with a project. So solar farms, once you kind of build the mechanics of how the model works, they should be a relatively known investment and relatively low risk, and particularly depending on how you kind of model your income revenue from energy, you should be able to predict it, at least a risk-averse approach to it, relatively well. So in community terms, I often think people look at a kind of somewhere between a 7 and 10% IRR, and communities cut it much leaner. for reference, the kind of commercial company is always going to be above 10, I would imagine. And actually, if it's a high risk project, it might be 20 or 30 because they deem the risk very high. And therefore, you're kind of compensating for that risk of investment is higher. You need enough cash flow, as I talked about, to pay your operational costs. And you need to think about community benefit. And realistically, even if you've got a really decent sized solar farm, I think you'd do well to generate 15 to 50k per year for community benefit. So as a kind of a marker stick for what it might look like. However, in an uncertain world where you suddenly get a bigger income, because say, for example, a wayward president goes and invades another country, then prices might go up. And then you might experience more, but you can't bank on it. When you look at the scale of the projects, I think that's a kind of appropriate level to think about what you might get, albeit if the energy market fluctuates and changes and go up, you might get more. Next slide, please. So the next thing to think about is not to overwhelm yourself with the amount of granularity you need to model. So models should always be as accessible as possible, and they should always be understandable, but a simple model will be easier to understand and move around with. But at the very first stage with kind of rooftop and even ground mount, you just need something really simple. You know, what are your kind of expected capital costs? What are your expected operational costs? How are you going to finance it? And what does that tell you about your IRR and your NPV? And there doesn't have to be a whole load of complexity to that model. If that shows you that it's worth looking at, that you then start to build out a pre-development model, which will have it will still be relatively simple, but that's going to have all your different kind of inputs and metrics and kind of global assumptions. It's going to have all the bits you know need to be in your model, albeit considered in a relatively simple way. It probably isn't going to be thinking about tax at this point, and it probably isn't going to be really granular in kind of cash flow analysis, but it's going to make sure you've got all the relative inputs to check the project viability still stands. Before you do a share raise, and certainly before you raise money from a bank, you're going to have a bankable or financial close model. And, you know, we have one of those. I'm very used to working with models. I still find it quite painful, even though I've been part of building it, because the level of complexity in these models is really significant. And even if they're not black box, even if it's something that people are willing to share with you, the chances are, unless it's something you're doing on a daily basis, it's not going to be comfortable or easy to use. Not impossible, but, you know, not comfortable or easy. If it is, you should probably have my job, because I don't find it comfortable or easy to use. And then you've got your operational model. You've built the thing, and you know you're now looking at the operational reality of that model and your turnover and adjusting the way you pay back your shares and so on, which I'm sure Simon will touch on. Next slide, please. I think I've lost my graphics here, but there is. It's fine, they weren't that exciting, but there are different types of finance you're going to use. So in very brief summary, and knowing Simon will touch on this more, if you're building a thing, and certainly if you're building a solar farm, you're probably going to have some bridge or construction finance at the beginning. And I'll talk about scale a bit much more with that shortly, but that is your finance that gets you through the riskiest bit, is in it gives you the money to pay for the thing to be built and allows you to refinance to more affordable finance once it's built. So we call that bridge or construction finance. You might have some surpluses, which you can invest as equity. And again, I won't touch on kind of equity versus debt too much, because I think Simon will cover that. But you are also likely to consider raising community shares, which are that is your kind of investment through your shareholders into the solar farm or rooftop solar. Community bonds are a way, and again, I won't go into a lot of detail because I know Simon will, but of raising community finance in a more structured way that is more akin to debt than equity. So it is a kind of commitment to pay someone who isn't a member of your organisation and with voting rights, but nonetheless, it's a community bond raised from the community. And then you've got senior debt from the bank. And there's also junior debt, but in effect, your loan from the bank they will be your kind of hardest shareholder in many ways, when they're the ones you have to pay back first. And they're the ones at the moment who potentially have the highest debt rate. Next slide, please, Faith. So again, do all three is fine. As an illustration, it could work really differently according to scale. And I'm conscious I'm kind of getting close to running over time, so I'll whiz through this. But if you're looking at a rooftop solar scheme, you might raise shares ahead of time. And so you don't even need construction finance. There are risks associated with doing that, but it's entirely plausible to do that. And, if it's a 100K scheme, you could do the whole thing through shares. If it's a 1 megawatt solar farm, it's not impossible you'll do the whole thing through shares, but you may well have some senior debt from the bank as well. And the amount they'll loan and the percentage they'll loan will be capped according to the project risk and the risk of your organization, but it's never going to be all of it. 60% is likely to be close to the upper limit. So you might, at 1 megawatt solar farm, have a mixture of community shares and debt from the bank. And once you get up to something bigger at 10 megawatts, you might find that the bank will only loan you, somewhere in the region of 40 to 50%. It's too tall an ask to raise the rest of it through community shares. And so you might have community bonds as well. So the point at a really high level is, according to the project size, you will flex and adjust your approach to how you finance it. Next slide, please. And again, feel free to flick through. Is that all of the ones, or is there something that comes up on there? Right, yeah, okay. So these are some of the things. Everything has an impact in the model, and models, financial models, really do pull out the reality of damn lies and statistics. The truth is, you can push a model in and out of viability very, very easily, which is why it's really important to kind of do a diligent job and have transparency about your assumptions. But things that are obvious, that have an impact are construction prices. Solar PV, as an example, has come down in terms of the panel prices, but the costs that sit around that remain stubbornly high. Even on rooftops, scaffolding costs are often really quite prohibitive. And so construction prices, obviously, as your big capital input, are going to have a massive bearing. And don't assume just because PV is getting cheaper, all the stuff that sits around it, like labor costs, materials, and so on, are going to go down. Like I said, inflation has a huge bearing. So because these are long life projects, it really matters to get your inflation assumptions right. So I've just used an example here, £10,000 OPEX cost in year one. By year 25, even with 2.2% inflation, we've often had more than that recently, it's going to cost you £17,000. And on a lean business model, that makes a difference. Debt costs, it's obvious. Debt costs make a big difference. They are spiraling upwards at the moment, although some people say not as much as you would expect. But just as an illustration, if you borrow £1 million over 15 years, which is likely the longest tenor, the longest period you borrow from a bank like Triodos, at 7%, that's going to cost you £650,000 of interest. And your business model needs to be able to bear that. Now, for illustration, if it was only 5%, it's £450,000. And so those kind of costs of interest make a massive difference. And that debt rate and the viability, it's going to be linked to the certainty of your income. So, if we're viewing it from a bank's perspective, they're going to say, how certain is it that this organization will get paid the income they expect? But they're also going to look at how established the organization is and their kind of track record and their ability to pay back. And that's going to have an impact on your debt rate. Next slide, please. I'm going to whiz through. Energy prices, it's obvious, they make a difference. The wholesale market is a nightmare to predict. And there are various different views on how you should or shouldn't do that, but it's incredibly changeable. You're going to get a better income through an on-site, or private wire, which is why rooftop solar can be so successful when you have really high on-site usage. And a lot of the things we talk about, like corporate PPAs and virtual PPAs, which are a whole subject in themselves, they're going to bring you more income, but they take time. So don't underestimate the time it costs to get one of those. Next slide, please. So general thoughts before I go. Start with a simpler project if you can, although if you've got the ambition to do more, then great. Be conservative. Things, the income you get, it could go wildly more than you expect. But in general terms, often it can underperform and costs always escalate. If it's tight in the first simple model you use, it's unlikely to get less tight as you kind of progress. So it's not going to rescue the project. So do that kind of early thinking of kind of sensitivity and those early simple models to say, if we had a worst case, the downside, what will it look like compared to an upside? And then more generally, I guess the view as with Community Energy Go is we're trying to help with this as much as possible, and we will share our learning as much as we can. That is me. Sorry for overrunning.
No problem. Great. Thank you very much, Philip. Yeah, that's really interesting. And yeah, I'm always struck by, yeah, when we talk about financing and the cost of capital, because it's such a big factor and that really affects the business case and where the rewards go from like the cash flow of a renewable energy project over its lifetime. Because obviously we want to prioritize savings to the host buildings or building up a community energy fund. But I think that's establishes why democratic financing is such an important bit because so much of the money involved goes back to paying interest on kind of the capital involved. So the more that can be retail investors and community shares and ISA holders and bond holders, I think that's the real big difference between some of the ways renewables are being delivered at the moment. Okay, yeah, so please do we're going to move on to Simon's presentation now, but if you have questions for Philip, either hold on to them for a few more minutes or feel free to make a note of them in the chat so we can pick them up that way. I don't think we've got a Q&A function enabled, but we'll pick them up in there. Right. So, introducing Simon, he's the founder of Commonly, advising cooperatives and social ventures and charities on community shares, governance, and digital topics. Over the last decade, he has worked on a number of programs supporting community energy groups to raise investment from their supporters and members, including the Community Shares Booster program and Community Owned Renewable Energy, the core program. He is also one of our associates for Community Energy Go, providing community shares and governance expertise to groups. So over to you, Simon.
Thanks, John. Hope you can all hear me. So I'm just going to hopefully introduce community shares both in terms of the sort of theory behind it and then the sort of practical considerations when considering a share offer to raise equity investment for a community energy venture. So John's obviously given you a bit of an overview of myself, but the next slide will just hopefully give you my background. So yeah, fundamentally, my background is in community shares rather than community energy. But naturally, community shares has been a really key part. Well, community energy has been a really key part of the community shares market, and is it's been over the last. I've been involved in community shares for nearly 15 years, which again maybe shows my age. But there's it's been a really key part of the community shares sector. And so there's lots of experience and case studies and best practice in the community energy sector when it comes to community shares. So I'll definitely encourage you to look. There's a lot of resources from the host organisations here today as well. So and then actually my sort of hands-on experience with community shares is I'm a director of a organisation, so not community energy, but own and run a community hub space in Manchester where I'm based. So I've been involved in actually running share offers. And so I do think learning by doing is a really key part of the kind of community shares piece. Anyone that's interested in community shares, my encouragement is just to go for it, and you'll learn so much through going through the process. And I also set up a online share register tool called Air Register, because at Stretford and I will come on to that, the kind of admin and management of share offers, which is a part of the experience of using community shares. And then, as John said, I have, through my community shares work, I've worked on community energy projects through various different programs and providing support. So what I'm going to do is just give you just a quick overview of what we mean when we say community shares. So hopefully the next slide will. So we'll just go through community shares, a bit of practicalities of how they work, a bit about if you were going to do a share offer, how that would work and how you design that, and then a little bit of information about community share standards, so best practice out there, and then the kind of potential support you can access to help you consider a share offer. So what do we mean when we talk about community shares? If we just jump to the next slide. So community shares really is this kind of two-way relationship between you and your community. So it allows your supporters, your residents, your advocates to actually invest in a community-owned organization. And through that investment, the organization is able to raise patient, long-term, aligned capital, what I think of as the right type of money for these types of organizations. And ultimately, through ownership, democratic participation, the community organization is accountable to its members. So it's a really kind of strong proposition to actually allow community organizations to live and breathe community ownership through allowing their supporters to invest. So just a few practicalities that underpin community shares. So community shares in essence is actually a brand that has been developed by lots of organisations working in the field, including Cooperatives UK, Locality, who set up the Community Shares Unit that I worked on back in the heady days of 2012. But the brand actually is used to refer to a type of share capital that is unique to a legal form called Cooperative and Community Benefit Society. And that share capital is often also referred to as withdrawable share capital. And the withdrawable bit I will come on to because that's basically why this type of equity investment works so well for community organisations, because it behaves differently to share capital that you would find in an ordinary company. So like I say, why does it behave differently? Well, this idea is that the shares are withdrawable. So in essence, the member asks the society to buy the shares back on agreed terms. And I'll come on to actually what that means and how that works in practice. There is a return profile for shares. So there is an element of sort of financial compensation, which is interest on share capital. But more fundamentally, the motivation for investing is usually because the community believes in what that organization is trying to achieve through raising that capital and wants to be part of it. And when we say they want to be part of it, it allows them to be a member. And a member in a cooperative or community benefit society is built on cooperative principles around democracy. And so the idea is that irrespective of the amount that you invest, every member has one vote. So you're building in democratic ownership and participation in the design of the investment. And like I say, community shares has been used to fund a whole wealth of community-owned assets, projects and ventures over the last 20 years. And actually a large proportion of community energy ventures have used community shares to raise the capital they need to develop their renewable energy project. So we just move on to the next slide. So so basically, why community shares? So like we say, the idea is that this capital is long-term patient risk capital. And so it's well matched to the community energy business model where you often have a large capital requirement early on, but then you have a relatively steady return profile that allows members to withdraw their investment over time on agreed terms. Another key component of community shares is the leverage factor. So by an organization by being able to raise investment from their community shows there's significant buy-in and support for what they want to do. And that convinces other funders, whether that's grant funders, debt providers or even shared ownership arrangements to kind of come in alongside the community. As we said, by investing in community shares, that connects the supporter to the organization and gives them a meaningful say in how that organization is run through having a vote at the AGM, being able to stand as a director. And also by connecting your community to the organization through investment, you're actually drawing on all the different qualities and characteristics of your supporters so they can become customers, they can become advocates, and actually drive the growth of the organization to think about future projects. So it's giving your community a number of hats to be involved in the organization beyond just being investing. So just the next slide will give you a little bit of an overview of the community shares market itself. So yeah, it's a relatively mature and sizable sector these days. So over £200 million has been raised from community shares across over 500 different organizations from a wealth of sectors. And over 100,000 people are now investors in community shares across the UK. And another really kind of important characteristic is organizations that raise investment through community shares are really resilient. So essentially, 92% of those organizations that have raised community shares are still trading. In terms of energy, energy has always been a large proportion of the community share sector. And when we say large, I mean large in terms of the number of organizations issuing community shares, the number of members investing, and the amount of capital raised through community shares. So the average deal from the community shares market report was around £500,000 raised for a community energy project, and it's been a relatively steady sector, looking at around sort of 80 offers each year coming out to help finance community energy projects across the UK. So next slide. So yeah, I'm going to skip on because I've just had a few kind of examples of different projects and different parts of the community energy sector here. But given that I haven't got much time, I'm going to just move on and just go through the practicalities of shares. If we just move on to the next slide. So yeah, I just wanted to kind of come back to this legal structure piece because I think it's quite important when thinking about whether community shares will work for your community energy project. So as I mentioned, community shares are the term that's used for withdrawable shares. That's a unique form of share capital linked to the society model. So in order to be able to issue community shares, you have to be registered as a cooperative or community benefit society. And they're kind of three variants of the society model. So the cooperative society is like the traditional cooperative model, which obviously the UK has a strong heritage in, most namely the cooperative group, which is a customer-owned business. And there the idea is that the organisation exists just to benefit its members. So ultimately, that often has not been an appropriate or feasible structure for community energy because ultimately the trade, which is the generation of electricity and the sale of electricity or heat, is not directly linked back to the members as customers, but goes through the grid. So in the majority of cases, community energy will use the community benefit society legal form. It allows the society to issue withdrawable shares. It also brings, I think, some really valuable features that kind of, again, demonstrate the kind of community ethos of what you're doing. And one of those is the term of an asset lock, which basically a community benefit society will have this built into the rules, which means that the assets that are owned by the community organisation have to be will always be in community ownership. So in essence, the society can't sell the asset and allow the members to make the private benefit beyond just getting their investment repaid. So again, alongside the sort of democratic ownership features of the society, the ability to have an asset lock and demonstrate to your community that by them investing in something that will be in community ownership in perpetuity, I think is a really powerful feature to bring people alongside what you're trying to do. You can also be charitable. So a community benefit society can get exempt charitable status, but again, the generation and sale of electricity in as a standalone trading activity is often not recognised as a public benefit. But there have been instances where a community energy project would form part of a wider charitable organisation, and that can allow an organisation to get charitable status and the sort of fiscal benefits that come with that. So I'm conscious that I probably don't have a huge amount of time. So I just wanted to just flag this idea of this difference between, so community shares, as I said, is withdrawable share capital, and it basically just behaves differently to ordinary shares, which a lot of people will kind of be aware of in terms of the ability for companies and company law. So the idea here is that shares are often sold to another buyer, and so the company doesn't actually have an obligation to buy those back. And actually in ordinary or transferable shares, the level of shareholding links to the level of ownership or stake in the organization through votes or control. And so these kind of features aren't really available or friendly to a kind of community or cooperative model, because again, it would impact on their ability to be democratic, and also the ability to kind of allow the investors to access their investment would be through like selling and moving ownership to a third party. So this is where withdrawable shares come have their benefit, because they basically allow the society to offer a withdrawal terms. So in essence, the share capital is paid back to the member. The key thing is it's linked to the performance of the society and linked to the performance of the business. So in essence, the society and the board get to set the terms and the pace of the payback. So that's the idea, is that often it's patient, it's long-term. Investments are are linked to that kind of 20-25 year lifetime of the project, and the withdrawals kind of follow that. And it provides a kind of way to allow investors to get their money back over time. And again, while maintaining the democratic features of the organization. So if we just move on to the next slide. So I just wanted to quickly flag what Philip picked up in his presentation. So as we say, there is societies have the ability to both issue shares and secure equity investment in the organization, but they can also issue debt or a loan that in essence would be targeting the same supporters or your community. The difference being that with a community bond, you're essentially just treating your community and supporters as lenders rather than members. So you would essentially wouldn't be offering ownership rights or membership rights. You'd just be allowing them to participate through providing a loan to the organization. And on that basis, the financial return is less linked to the business performance in the sense of what you would expect with an equity investment. And usually in a community bond, it would be a shorter term and a more kind of fixed interest rate. So it's a slightly more kind of structured, stable form of raising finance, which, in some cases provides a little bit more certainty to both the organization and the investor in terms of the return profile. But like I say, it means that you're kind of not able to kind of access that kind of membership and ownership feature that often community energy organizations really benefit from allowing people to actually take a meaningful stake in the organization. So if we just move on to the next slide. So again, in terms of the sort of steps to getting this wider community to become members and investors, there's this kind of process by which you'll be operating, you'll be working or active in your community. So it's useful to understand, how big is that community? What's the demography of that? What's the behavior? And then essentially what you're trying to do then is in that community, you want to let people know about what it is that you're wanting to do. whether that's a rooftop solar scheme. And so you want to create an audience, and that audience is basically people that know about what you're doing. And once you have identified that audience, you then want to try and convert those people into supporters. And so you get to know about them, you have an ability to contact them, and they essentially are getting behind what it is you want to do. And then the share offer itself is the opportunity then to convert those supporters into members, because you're inviting them to invest, inviting them to become a member of the organization. And as you can imagine, it's kind of like a ladder of engagement, going from a large community to a small audience to a smaller pool of supporters, and then finally your kind of backers and your members and your investors. So in the case of Stretford Public Hall, of which I was involved in the share offer, we have an overall community in Stretford of around 40,000. We think, we enabled about 10,000 people to be aware of what it was we're doing. We built a supporter base, a mailing list of around 2,500 people, and out of those 2,500 people, we now have 1,000 members that have all invested in our share offer. And again, that investment can be anywhere from £50 to £100. The average is around £300, but often individuals can invest into the thousands. And the legislation itself allows people to invest anywhere up to 100,000. What I would say is, even if you had someone knocking on your door wanting to invest £100,000, that can in itself bring a risk, because obviously you have to pay that investor back, and having it all in one investment can just bring a slightly more risky proposition. But that is the ability. Organizations can invest as well, so it doesn't just have to be individuals. And so quite a lot of organizations have raised investment from their community and kind of supportive organizations, including local authorities, housing associations, and other kind of anchor institutions. I don't know how long I've got left, but I've got a couple more slides. So a share offer works a little bit like a crowdfunding campaign, where you have a target, so the amount that you're looking to raise within a certain time. With share offers, you sometimes have 3 targets. So the minimum amount is where the society work determines what level of investment they need to actually enable the project to actually be viable. And that can be, that will be determined by the capital requirement. You'll then have your optimum target, which is your kind of best case scenario. But you can also have a target which is over and above that, which means that the society has identified things they can do in addition to their kind of optimum raise, and that could be about refinancing or thinking about future phases. And so a key consideration is about where you set those targets, and making sure that those targets reflect your capital requirements. So if you don't meet your optimum share raise, can you pull on other forms of funding to allow you to proceed? Likewise, if you go over your optimum, have you actually built in the consideration of how you're going to repay that additional share capital back over time? So the next slide just talks a little bit about withdrawals. Oh yeah, I just wanted to show you. So in terms of shares and energy, as we said, the overall deal size is around 500,000. And in energy, that's about the mix is often, and I know Philip had like a slide showing that, is so often that's about 2/3 will come from community shares, loan finance 1/3, and then grants actually have been a relatively small proportion of the kind of capital requirements of community energy projects. There have obviously been grants that have come in to community energy projects for that development and pre-feasibility, but the actual kind of capital piece, grant has traditionally been a smaller piece of the fundraising mix. I've just shown you a couple of examples there of other kind of sectors. So as you can see, community hubs and housing will often have larger grant components, and then the shares will be different, will be a smaller piece in that overall funding mix. So the next slide. So yeah, this is in terms of the withdrawability piece. So obviously, the key thing about community shares is the society having a plan about how they're going to pay those shares back over time. And the FCA, which is the registrar for societies, sets out that ultimately a society should only allow withdrawals if their trading surpluses match or exceed the value of the shares involved. So essentially, you have to be generating surpluses. And obviously, as Philip said, your financial model is a really key kind of component in trying to determine how you'll generate those surpluses. And again, factoring in things like the community benefit fund and your ability to generate income to support wider community benefit. But ultimately, as we said, a society will kind of bake in returns into the forecast from day one, and there's different ways of doing that. Quite often there'll be a scheduled drawdown because can be a relatively stable revenue. You can set out a planned drawdown. So essentially, rather than the shareholder kind of requesting withdrawals as and when they wish, you kind of build that into the funding and the business model and the forecasts. And obviously, as you allow for withdrawals, that is reducing the level of share capital in the organization, and then the level of interest you pay, which then can support increasing your surpluses and increasing your community benefit fund. So recognizing that the share capital piece has to kind of coexist with the other kind of financial responsibilities and commitments and aspirations of the organization. I don't know if I've got any more time. I know there's going to be a
for break for
eventually,
5 minutes before 1 o'clock, but yeah, just wrap things up. You're fine.
Research for.
Okay, cool. So yeah, essentially, when you do a share offer, you're basically looking at you need a share offer documentation, which consists of an offer document, your rules, which you would have at registration, but making sure that they are aligned with your offer, and then an underlying business plan, which sort of backs the upper option. That's where you'd have your detailed financial forecasts, your competencies and capabilities that shows that you've got the track record and the experience to be able to deliver the project that you're inviting investment for. And on the next slide, I'm just going to introduce this community share standard mark. So a key thing is that community shares aren't a FCA regulated financial instrument. So there's no kind of formal regulation around community shares. Any society can issue a share offer any way they like, really. But on that basis, the sector has developed a voluntary standard called the Community Share Standard Mark, and essentially provides kind of reassurance that a society has gone through a process to demonstrate quality and responsibility and consideration when raising capital in this way. And again, those sort of principles around, is it proportionate, is it credible, is it transparent, is it honest? So the idea here is not saying that this is a risk-free proposition, but actually if there are risks, that those are communicated and clear so the prospective investor can make an informed decision if this is something they want to support. And then the last slide just has a few kind of potential funding and support programs that you might want to consider if you are exploring a share offer. So the Booster program is run by Corporate UK and actually provides match funding so for every pound that a community energy project raises through a share offer, the Booster can match that. The Reach Fund is an investment readiness grant program that can provide grants to help you develop your share offer. And then obviously the Community Energy Fund and future iterations of that have feasibility and development funding alongside them, which would potentially enable share offer development to be considered. And then there are a number of specialist lenders that will look at either bringing debt alongside your community share offer or potentially coming in with institutional investment. So investing alongside your community in community shares. So all these are worth considering. So I'll leave it there. Thanks very much.
Thank you very much, Simon. That was really interesting, that breakdown of energy kind of finance contributions versus grants versus other sectors. And it kind of got me thinking about, yeah, when GB Energy 100% grant funded like solar rooftops for schools and hospitals, how much we might be able to do just by levering in a little bit of grant funding on the capital side to unlock some of these projects. I know there's some chat going on about the value of grants to make things slightly less marginal for the sector. But we had scheduled in a 5 minute comfort break. We're going to open the breakout rooms at 1 p.m. Are there any burning questions for Simon and Philip whilst we're all together? Feel free to put your hand up. Otherwise, I can pick something that's been going on in the chat. I think we'll take a few minutes break and then we can roll the questions over into the breakout rooms. So you'll have plenty of time with both Simon and Philip to talk through the points that have come up. So see you in a few minutes, I think. Back at 1 p.m. Question for you there, Philip, perhaps from Caroline in the chat. What's the brilliant example of solar schemes that work without feed-in tariffs?
You saved me typing an answer. I mean, I'm going to give an annoying answer in the sense that every site is different. But if you have a simple rooftop, which is to say a roof in good condition that is simple to affix solar to with simple scaffolding, and it's 100 kilowatt peak, and you use 70-80% of the energy on site, as in you sell that on site, chances are that's going to work. So it's not the only system that's going to work, but that is a kind of measure of something that's going to relatively easily stack up because it's sizable enough and you're selling your power on site, for a significant enough proportion, and you'll earn more money for the power you sell on site than off. So yeah, we hope, and I think there's been a lot of chat about how marginal viability is. We hope and expect and certainly hope for GB Energy to kind of intervene in this space to provide support in the recognition of the additional value that community energy brings. But I think a site like that works right now. And there's plenty of people doing those sites. And it doesn't have to be as big as 100 kilowatt peak. That's just a kind of illustration of scale.
Yeah. Yeah, I think it's useful to keep an eye on what the commercial sector is delivering and how we can then replicate that in the social enterprise world where we maybe lack their kind of venture capital or kind of startup environment, but how GB Energy can support that instead. Yeah, we'll take Steve, you got your hand up. We'll open up the breakout rooms in a second.
Fascinating conversation with a professional sports club this morning around they have the capital cost, but they were more than happy to work with a local community energy group in a shared ownership of developing rooftop solar on their site. So if that's a model that can be replicated, that'd be very interesting. So yeah, there's some things that are not so obvious that we could potentially explore as well. So it's really exciting times.
Cool. Yeah, so whenever I hear the ministers like Ed Miliband and Michael Shanks speak, they always talk up the community wealth building potential of community energy and how that's a big part of it that motivates them is that kind of fairness and democratic finance. So how do we access the grants and liquidity of investment at the right stages of projects, and how do we also keep scaling the retail community share side of things? So maybe we can open up the breakout rooms there and head into some of those topics with Philip and Simon. So I think you might get a pop-up of which one to choose. Welcome back, everybody. I hope you enjoyed your breakout rooms. And yeah, sorry, we couldn't have a bit more discussion. I know we were kind of in full flow in the one I was in just now. There was one quick question that we missed just while we were breaking out to rooms that was for both speakers. It was from Shirley, and are there particular funding mechanisms that are more suited to different generation technologies or energy projects over others? Yeah, so I don't know if either of you want to comment on that.
I don't think I've got a good answer to that, actually. I don't think so. Different projects carry different amounts of risk. And so, certainly, in terms of a bank's expectations of how much they're willing to borrow and how much they would expect you to bring as equity would change. Um, in essence, they want more community shares or grant or equity against a more risky project. So solar is at the far low risk end of that spectrum at the moment, and some of the more complicated projects around kind of geothermal and so on would be at the other end of that spectrum. So I think all funding options are probably open to each technology type, but you might end up with different expectations of how much equity finance you need to bring for the more risky stuff. But yeah, no clear answer, I'm afraid. I'll pass over to Simon in case he does.
Yeah. I mean, I suppose I'm going to be equally frustrating and say that I would say that, yeah, community shares is a funding tool, I think can be applied for all different technologies and projects. And that sort of is the value of it as a way of raising finance. For me, would be then actually the share offer design and the terms and conditions associated with that would vary based on, like you say, and I do think it is ultimately because of the risk profile of that technology. So, in essence, like, are you if is it something that is riskier? Then actually, do you stagger your share offer? So actually, you might need to actually raise some share capital for what's called like development or pioneer. So actually, free trading activity to just do that feasibility. That's very risky, and that would need a different type of share off there. And then ultimately, even if you proceeded and moved on to the construction phase, like you say, what are the terms and conditions of that community share capital and how it interacts with other funds? So essentially, if it's a significant capital outlay, then the share is going to be a relatively small piece in the funding jigsaw, and that is just going to always impact about actually the certainty and confidence around the returns, because it's got to rub up against all the other forms of finance that are also playing out.
Okay, great. Steve, did I see you had a quick comment, or otherwise I'll start to wrap things up?
Yeah, no, it's just something that came out of the meeting. I was just going to finish off. I got drawn back in here halfway through, which is perfectly fine. I talk an awful lot normally. So just to let everybody know who's on this call, it's perfectly reasonable for you as groups and organisations to only have a fundamental understanding of finance. You know that this is why we're all here to discuss it. So always feel your questions are always welcome, very welcome, and there'll be somebody else in the room who had that same question in their head as well. So keep asking. Also, if you do have any generic questions that you want to raise, feel free to send an email to one of your development managers who you're working with, because we collate all these general questions, and this is how we put together these webinars. So keep asking questions. The associates you're working with as well, feedback to us on these kind of general points. So the more questions, the better, because then we can react to those and put these kind of things together. So yeah, thank you for the questions you ask, and keep doing it.
Thank you, Steve. That's a good point to finish things on, I think. We're all learning something new every day. So yeah, the more we talk and communicate, the better. Okay, I think so. Thank you so much for coming today, and thank you to our two brilliant speakers. So we can give a round of applause or rocket emojis or feedback of choice. Great. So our next webinar via Community Energy Go will be a session with Saskia Huggins, titled Good Governance, Practical Foundations for Community Energy. And that is going to be on Thursday, the 11th of June, from 1:30 to 2:30 p.m. We'll send the sign up link around after this, along with the slides and recording for this session as well. If you haven't already, please register your interest for support through Community Energy Go and read more about it on the website. So the link will be in the chat. And then finally, be very grateful if you could complete our feedback poll, which will be popping up on your screen imminently, if not already. And we'll leave the session running for a couple of minutes for you to complete it. There we go. Yeah, it's always good at this time to give feedback to funders about how these services are helping you on the ground. But yeah, there we go. And any final questions or contact details? Yeah, we'll leave the chat open for a few minutes as well.